This is the episode where if you did your first, second, third deal and you're looking to get into bigger commercial deals, what is I'm just gonna say it, the easiest way to get into a bigger commercial real estate deal? I'm sitting down again with Ian Cruz, who is doing just that.
I'll announce it soon, but it is over 500 units there.
What's the lesson learned? The lender's not gonna give you $5 million without the experience.
Turned out that it was very difficult to find a small balance commercial loan being an out-of-state investor without experience over in Ohio.
And we're gonna talk about what it takes to be a co-GP. What value could we add to the big fish to team up with them? If you want a co-GP, what do you think is the next thing that they should do? Ian, welcome back to the show.
Thank you for having me again.
Okay, so for those who don't know, we talked to Ian, I want to say it's almost been a little over a year ago, right? You were just getting to multifamily. We talked about how much value adding an ADU to a property, in this case it was a small apartment complex in the Bay Area, can add to value. Since then, you have made some moves. So in the last, 18 months, what moves have you made?
Yeah. So I started off in the Bay Area focusing on an unusual transaction, which is a build-to-suit 1031 exchange, which allows you to withhold some of the proceeds of the sale of a property to make additions or improvements to the property. So what we did was we took a 5-unit and we added an ADU. Due to the timeline, we had to go prefab, but we added an ADU to that property. I think there was a lot to dive into that transaction, so feel free to watch the recording on that. But separately, actually around the same time, I was also buying a 6-unit in Cincinnati, Ohio, starting to build and scale a portfolio over there as well. And I always had the intention of scaling into the larger multifamily. So I started with what I thought was going to be easier with on the smaller side, commercial multifamily, right? So for those of you listening, commercial multifamily is anything that is 5+ units. Those properties are treated differently. I mean, for lending purposes, insurance purposes, they're classified differently. And I thought, oh, this is going to be lower risk because I'm starting with something smaller. And it turned out that it was very difficult to find a small balance commercial loan being an out-of-state investor without experience over in Ohio. So that was definitely a learning lesson. But from there, I have been slowly scaling a portfolio. And most importantly, building the connections with both other investors and other parties and boots on the ground that have really made this work. I've had just incredible partners over in the market of Cincinnati that just make everything go.
Okay, so you went, and since we've now seen each other a lot of times over the past year, you went from, was it an 8-unit, right? Or 11-unit? How many units is that?
Which one in?
The one in Cincinnati.
Cincinnati. I mean, the first one was a 6.
Okay,
and then
6.
we did 2 separate 8 units.
Okay, so
we did a subject to deal and we did an Airbnb.
Okay, yeah. And that was all in the last basically year and a half or so.
Yeah.
And then most recently, the one that you're working on now is you are co-GPing, which means you're partnering with another team to then tackle. It's a nice unit size for the Instagram. How many units is that one?
I'll announce it soon, but it is over 500 units.
Okay.
There were 2 separate offerings, and the fundraise was a very interesting process. It was a really great learning experience, and the team itself has just been incredible to work with. They have such a strong track record in Cincinnati, so we were honored to be able to partner with them and really learn from them.
Yeah.
I used every opportunity I could get to pick their brain, and sometimes they knew me as they have an impression of our LPs asking a lot of questions. Sometimes it was just me starting to ask more questions, but I told them, like, I want to be prepared for everything, right? I want to learn everything that I can. So they've become mentors to me, and it's been great.
What I want to dive in today is, I feel like the natural evolution is investors will do a couple single family deals or one, an Airbnb, something by themselves or with one other person. And then at that point, it is hard not to think, well, how do I add a lot more units in a transaction. And a lot of times, co-GPing is the way, at least for you and for me, that you can get into it. How about you break down from your understanding, what is co-GPing?
Yeah, so being another co-GP on a team, especially being with somebody who's very experienced, such as yourself, being with Tony Lin and Link Multifamily, it's a great way to get some experience and see what goes on from the perspective of a lead GP, of an operator, right? So, for example, Tony has gone full cycle a number of times. I think I had a healthy amount of delusion when I started because I was writing on some stuff that I had no business writing on. And I was talking to brokers that I had no business talking to, and I was very persistent. But as I got more into the market, I started to realize that some of these partnerships have helped me at different scales. So for example, before we did this deal with Venture, which is a large deal that I'm a co-GP on, we partnered with Slocum Reed of the Best Ever Network, and that partnership has worked beautifully. Taught me a lot, and it helped to scale. I realized how important it is to have a good local partner with a lot of experience on your team, on the ownership side, right? So that helped. And then as far as getting into the very large multifamily space, the large syndication space, there are just a number of hats that you have to wear. There are a number of roles, right? So there are 5 roles within the GP. There's the deal sourcing. There's the earnest money, the at-risk capital. There's the asset management. There's the investor relations, and then there is the key principal, the balance sheet, loan guarantor, right? So, did I miss anything there?
No.
Yeah. So those are all the roles that people can play within the ownership side. Us being co-GPs with somebody with such a strong track record, you get to learn so much. I know you help Tony on the asset management side. Naturally, investor relations is kind of what people dive into to start. But I was very selective with what kind of project I wanted to co-GP on because there's an opportunity cost to being a co-GP as well, right? Everyone wants to show off on Instagram. They have hundreds of units, but realistically, there's an opportunity cost to raising or being a part of a bigger project and being in a minority role versus doing your own. If you raised $1 million for your own burr on your own and you were everything, it's honestly probably more profitable there. But to be able to be a co-GP, work with the right people, give my investor base something when they've been looking for something and nothing is penciled out and they've watched me for so long, right? Like I said, almost delusionally, like telling people why I think this should go at this price. And as much as I built traction with brokers and people saw like, hey, I host a field trip to Cincinnati, I have Bay Area, Silicon Valley investors and capital, like it's available. I'm still, no matter how much I was talking to brokers, I'm still technically the least likely to close compared to these big players, right? So taking things one step at a time, being a co-GP, being able to work with a great team and learn from them, and tap into one of those hats, right? Probably it's you want to help, but you also don't want to get in their way. I mean, the group that I co-GP'd with has been full cycle 28 times, right? 38% average IRR. They're very, very well polished, right? So you try to help where you can. You ask good questions to start the conversations that help them to think about what their next moves are. And then you naturally bring your own base of investors and get to share the deal with them as well.
So let me add on a few things there. First, I'll simplify it, right? Going back to multifamily 101, you have your general partnership and your limited partnership. This is just for the viewers itself, right? You can either be part of one of the 5 roles that Ian mentioned as a general partner and have a active stake in the deal, or you can be passive on the limited side. Now, to get an active stake, today we're just straight talking GP-ship and whatever that means. There's a variety of different ways, and here's why it's, as you think about, cool, I want to buy this 100-door apartment complex, why it's tough for newer investors to just do it by themselves. right? Say, for example, if the deal is worth $10 million and you have to get a $5 million loan and then bring $5 million to the table, that in itself is tough, right? And I didn't, like, initially, like, oh, I could do that, and I can maybe just find, like, one or two of the people to help me get there. But I think as you get more talking with lenders, people don't realize that the lender's not going to give you $5 million without the experience. The lender's not going to give you $5 million without a net worth of at least $5 million. And then you also have to have a certain amount of liquidity needed after post-closing that includes after you put in your down payment and you raise. And most people don't realize how much money that actually takes, not also accounting for how expensive due diligence is on 100 units.
Yeah.
Like your due diligence for a single family house in the Midwest is probably, I don't know, $1,000 at most. For a bigger deal, you're spending tens of thousands, not including your attorney fees.
Yep.
So yes, co-GPing is the way. To simplify it for me, I see it like the apprenticeship model.
Yeah.
You have the mentor, the person who's been there, done that, can check those boxes, and hopefully has a little bit of an appetite to bring the next generation along.
Yeah, that's exactly it. There's a lot of work. Usually, the lead sponsor is going to walk every single unit. It's a big due diligence process, right? And as you work with a more experienced operator, I mean, the group that I worked in has done all their deals full cycle in Cincinnati, and they have been trying to operate in Columbus. They've trying to go a little bit further, not all the way out there, right? Still in their relatively in their backyard.
Can I pause for a second?
Yeah.
Full cycle, define that.
Yeah, full cycle is from purchase to exiting the property, right?
AKA selling it.
To selling it, yeah.
So then that means they have now, basically, if you flipped 100 doors, you flipped an apartment complex.
Yeah.
Okay, continue, sorry.
Yeah, and full cycle deals typically are about 5 years. Most investors want to see their capital back within 5 years. In the case of this operator, it's been under 3 years. And then you can also refinance. Those are also very lucrative opportunities because those are tax-free, depending on how the operating agreement is worded, if it's a return on capital versus a return of capital. So those can be, those are important distinctions to make. So a return of capital is money that's tax-free that you can then go ahead and invest in another project, right? Which is great. On the flip side of that, it's not part of your cash on cash. So some people want it to be return instead of return of capital. It's return on capital is like your cash on cash, but there's tax implications to that. So very important distinction to make. Probably a more nuanced kind of advanced conversation, but that's another big. A refinance doesn't mean the project went full cycle, but it's another big liquidity event. To get back to this group that I'm talking about, they have a harder time. Basically, they underwrite even more conservatively when they go into a market that's further out from where they're used to doing business. And then for us, being Bay Area, we underwrite based on the rates that we can get, the debt terms that we can get, which aren't going to be as beneficial, the insurance quotes that we can get. So I was always underwriting $500 a door for insurance. That's not the same rate that somebody that has a massive portfolio to spread risk on would get. And especially if they have a history of not filing claims, just kind of paying for things as they come, they're going to have a much better rate than what we as operators would be doing. So I was always underwriting really conservatively and just not coming close, and being the person that hasn't gone full cycle on the deal, it makes it very difficult.
For sure. So let me just to summarize that, right? You think about it as we are here out-of-state investors who want to get into the bigger deals. The barrier is there's going to always be bigger fish with more cash than you, more experience than you, can get better rates than you, and therefore you will always lose to them until you can be the big fish yourself. And I guess in our sense here, what value could we add to the big fish to team up with them? I'm trying to think of different scenarios in where you can beat the big fish, but if they come into the same deal as you, you're not going to win. Like, there's just no way that the seller and the broker is going to trust you, or the lender is going to trust you to close. Because if you full cycle and you exit 28 deals, yeah, for sure. Why would they pick me?
Yeah.
Like, there's no way.
Yeah.
Even if they offered less money, they'd still probably take that guy.
Yeah.
So, okay. The next,
I have a question for you, actually, because you co-GP'd with Tony. You also revamped his website. Am I right there?
yeah. I mean, I did draft it, and then internally someone else took that. But yes, went through 80% of that. We helped build out the pitch deck entirely. Made all the marketing materials. Whatever videos and pictures we had, I just completely redid however he would normally present. And then, of course, he added his numbers and his magic to it, right? But
so that's definitely the value a part of the value. You added a lot of value, but it's a different investor base that you were able to bring along to that deal, and then some marketing, some asset management. So he saw a lot in your group to be able to be that co-GP. We were both mentored by Tony Lin, by the way. And one of the things that Tony talks about is not having too many co-GPs at the table, because then there are just a bunch of people that sometimes there are arguments, sometimes there are things that go wrong with too many co-GPs. And sometimes, I mean, you shouldn't just have a bunch of co-GPs for the capital raise, but essentially that's what it becomes for some of these projects, where a bunch of people join like some group and everyone thinks, hey, I need to close a deal by the end of the year. And then when you look at it, it becomes like 20 GPs that went to their family and got like 200K each, right? And those deals can get a little bit more messy. So it's good that you guys partner with Tony. Tony made it very intentional who he was bringing on board. And it's one of these things where it's like, yeah, I want to partner with the best, but then at the same time, all of a sudden, when the best out there, why would they want to partner with you, right? Like, what can you bring? So that was awesome that you had it's you and Invest, right? It's you, Jason, Vinci, and Ash, right? You all bring your own skill sets to the table, but as one co-GP, it's awesome that you were able to have a lot to offer, right? To be a part of that.
So for that story in particular, for us to then find the bigger fish who's willing to let us team up, Ash really owned that relationship and connected with him 2 years before I ever met Ash.
Yeah.
And once a year, it would just continue to show up. And then once we started our meetup, our group, Tony would come. And then we also continued to show up to his events too. Like, showing up is, I would probably say, like 90% of the battle. Like, even if you don't even think that you would ever do a deal with someone, like if you just showed up to their event, their meetup, their coffee, like 6 times, at a certain time, you can like actually plug them and ask them for something. What about for you? Like, okay, so you said that you partnered up with Slocum Reed, who hosts the best ever podcast.
Yeah.
Right? How did you even partner with him?
Yeah, that is, I mean, even before Venture, I was like pinching myself that I got to partner with Slocum, right?
Yeah.
So it's like really great people to make these things work. So I partner with Liam. You've posted a video about Liam. It's Liam and Slocum and I are the Class A members of a joint venture. And Liam met him at the Best Ever conference.
Yep.
So that was a relationship that he built and then just kind of kept in touch with. And I met Slocum at the Best Ever local meetup over in Cincinnati. And I think that's a great meetup. They do it monthly. And it's not as packed and crowded as BC, right? So you get remembered a little bit more and a little bit better. Separately, Liam and I'd say Liam was the relationship holder with Slocum more so than myself, because he had known him longer. But Liam and I were hosting these underwriting calls, and Liam, we hosted an underwriting call in an 8-unit in Northside, which is where Slocum lives. His office is a walking distance to this property, so it was just a very easy deal operationally, and we generated some interest on that deal, but we didn't get it. And that was a deal that I was looking back at the timeline. We had our first call on that deal in July, and then Slocum and Liam walked the property together, and Slocum was like, I like this property. So he was more, he was kind of hesitant on a partnership at first, but he just kind of kept talking to us. But he was like, I do like this property. I do see the potential there. And we just kept talking, and he was open. We weren't sure if he was just going to be a property manager or an owner, but they just kept talking. The deal fell out of contract, and we got it under contract in November. So that's 4 months after we hosted a call. But then when we were able to get it, because we planted the seed earlier, right? They always say, if you're capital raising once you have a deal, it's too late, right? So we had planted that seed and showed people, this is how we think about it. We're not going to go higher than this number. There's potential here, but we're not FOMOing into this deal. And November, it was like we had our call, boom, quick 40-minute call. It didn't need to be much longer. Me, sometimes I'm bad, and I make my calls way too long because I try to overshare information, but straight and to the point, oversubscribed. It's a small deal, right? So it was super, super interested, and Slocum's like, let's do this, right? So, and then we closed on that in February.
So because you hosted a Zoom call about a deal with someone who was local and got them to speak on that call, I'm assuming, or no?
Yeah.
Okay, so then he came and spoke on the call, which is great. Like, this is also why, I love when people just start to host a party. It doesn't have to be a formal meetup. It doesn't have to be this crazy thing, but just find some type of party and host it and find different ways to add value. And then because it was a deal in his backyard and he already had, mutual relationships, it's a very low pressure way for him to just come in for 30 minutes, give his 2 cents.
Yeah.
And then it was half a year basically cultivating that.
And in between July and November, in September, we had also hosted the Cincinnati field trip. And that was when I brought a base of people, and we toured his office. We walked around North Side. He had a good time with us. So I'm sure over time, all these different touch points were. So I'm sure that over time, all of these different touch points just made him really warm up to the value that we bring to partner with him.
Oh, 100%. Because now, again, hosting the party, now you're hosting a party in his backyard.
Yeah.
In his city. And then you're bringing these people who are the investor base to it. Yes, that is the easiest way to differentiate yourself. Mm-hmm. Okay, so not everyone's going to host a field trip. How did you then? So that was one partner with one big fish. Mm-hmm. And Venture is another big fish that you're working together with now. How did that relationship start for you guys?
So Venture is a massive fish. They're I think they're the best group in. I'm so biased, but I think that they're just so incredible. So our roles are a little bit different. Like when I think about scaling the small joint venture role, where we're very, very, very involved, and we talk a lot. That's with Slocum, where I'm very involved. Venture is an operator that we already were very familiar with them, but they had no idea that I existed. We know many of the same investors. I guess I'll just say Wakefield bought a deal from them, so his offering was purchased from Venture. So I saw firsthand what Venture did with a very distressed property to turn it over, and Wakefield's very experienced as well, right? So over time, we've seen Venture on the selling side or even the buying side of various deals that we're familiar with, and I host all of these underwriting calls with other investors, and I started to just put together that this group really knows what they're doing. Like, they're really good. If they owned a property, they must have operated it well. And it was even to the point where one of my notes, there was a distressed property, and that property had changed ownership a few times from one of these co-GP groups that had like a really scattered GP structure. But then when I started to dive in, I was like, Venture once owned this. It was once operated well. I actually like this location. There may still be potential to turn it around if we can get the right PM in there. So basically, I lurked heavily and knew so much about this group. And separately, I I think everyone should, well, not everyone, but for me personally, I like being both on the GP and the LP side, especially right now. I'm looking for more opportunities to be an LP. So I called Venture to be an LP. And my first conversation with Robbie, we really hit it off. Didn't even talk about real estate at first because he accidentally logged in on an account that was like a company he started years ago. So he's pretty entrepreneurial actually. And we talked for a bit, but he saw how well I knew his deals, right? And I think that went a really long way, because I'm not like an LP that's like, tell me about what's a cost segregation, right? Like I came in and I was like, I love this deal. I love what you did on that deal. And he was like, wow, how strange. You got this West Coast guy that's a diehard Bengals fan that knows our city like nobody's business and has his own investor base. I told him about the field trip. I told him about all of this stuff. And he actually, on our very first call, he was like, you should be a GP. And I thought it was a joke. I didn't say anything. We just kept talking. But then somewhere down the road, I just kept talking to him, and this has nothing to do with co-GPing with him. I told him I'm going to make a career transition into real estate, and we played around with the idea of me working for them in a finance role. So I think that's just a relationship, and you have these conversations. When he said that, I got really excited, right? I went home. I mean, I work from home, so I didn't go home. When my wife got home, because she works at the office, I went straight to her and I was like, oh, dude, like I got this awesome, Robbie said this. I mean, I think this may be my next step. That group is so local that they want everybody local, right? So that didn't go much further than that. But just over time, eventually it was like, what if I co-GP'd with you guys? And he was like, let's do it, right? And I looked at, for him strategically, they are at the right point where they had a certain level of their capital raises, right? They have their own investor base. It used to be at the $10 million range. Last year, they had an $18 million raise. This year, they're raising over $40 million for this project. So you may have a very strong and loyal investor base, but you're now asking them to invest twice as much as last year, right? So you're going to tap out, right? Especially as you're trying to scale, you need more people to come and look at these deals. And they're an unusual group because they are going through a number of cash out refinances during a time where a lot of deals need to be cash in refinanced, right? So there's a lot of liquidity in their prior deals that's just being reinvested into this new deal, but these new deals. But they know strategically if they need, if they're scaling as they intend to, and if they ever go a little bit further, they're so conservative, but if they go a little bit further into Columbus, right, or something else, they may eventually need to bring on other good partners that can grow with them. So that was part of the reasoning. And it turns out they really didn't need us at all because they were able to get oversubscribed pretty quickly. But I brought volume. I brought volume of investors and a lot of people asking good questions and us doing our own diligence on the deal and walking the deal as well. So it's been a really good relationship, and that was kind of the value we brought besides the capital, while also introducing them to 35 new LPs.
Yeah. So for Slocum, it was proof of concept that you can host a party. You obviously brought a deal to the table too, which was a big part of it. For this one here, you were so good at building relationships off the cusp, just trying to be an LP, which is a great door in. Everyone who's raising capital and running money for a deal is going to take that call.
Yeah.
So then that's your in, and you're so good at that call where it was like, dude, we should just hire you. Yeah. Or wait, you could also join the team on a co-GP side, which gives you that leg in. Again, that's kind of showing up. I think it's super important. What about in terms of, and this can go a variety of different ways. and we can share how much ever we want to share or not share. But in terms of like expectations, like co-GPing, obviously, let's just take, say, like the venture deal. You said that, well, they didn't need your capital. They could end up raising it all. But what is the realistic expectation that someone should have when co-GPing for the first time?
Yeah, and this is my personal take. I think what some LPs are not liking, let's put ourselves in that hat first. I think what some LPs are not liking are co-GPs that are really just only fundraising and moving on to the next fundraise, and really not staying consistent throughout the life of that deal. I expect our relationship with venture to be ongoing, and I hold some accountability to our investor base, but then I'm also another set of extra eyes while not being a burden. I'm not also going on site talking to contractors saying, "Hey, I'm a GP here." Like, I know who I am, but just having more accountability towards LPs. I think something that's soured a lot of people and it actually makes it harder for people to raise that were doing it 2 years ago, they're facing deals with capital raisers that need capital calls. So they're doing that, and then the capital raiser is trying to raise for another deal, and it just leaves like kind of a bad impression on people. So for me, it was very selective on who I co-GP'd with, and then for us to be at the table throughout the life of the investment, right?
Can I add something in there too?
Yeah.
Also, for the record, you can't just capital raise either. You have to asset manage in some capacity. So yes, that's a gray line for sure, but you have to make sure that you are still in the deal, and those that aren't, you better start asset managing.
Yeah.
Okay, continue.
And again, that goes back to the groups of like 20 co-GPs that were just in a group. What are they really doing, right? That's one of the red flags. So we're going to be like as involved as is practical for the life of the investment. And we have a good cadence with Robbie and Steven about, what's going on. I think after we close, we'll probably
Gotcha.
get in more detail as well.
Okay, and then so I'll take the answer to the question first. In terms of returns, for us, co-GPing with Tony on this one was really just for track record. One thing that we learned early on was that no one will give you a deal if you've never gone full cycle, especially a big deal. It's impossible. And so with that, we just wanted to get a seat at the table, and we weren't expecting a lot of return. Yes, you raised some money. We got a little bit of the acquisition fee, a percentage based off of the amount that we raised, and then we got a co-GP spot, but we also then bought in as an LP. And that's really largely where our upside is how much money do we bring in as an LP, and that's where upside is going to be. We also got a seat with very, very minimal GP side, just so that we can have that as a track record and resume, and we were okay with that. What about for you? What was kind of like the baseline expectations for you?
Yeah, are you talking about the splits?
Yeah. I guess splits, and it seems like the 8-unit one was a smaller deal.
Yeah.
But maybe even on the venture side.
Yeah,
if you can, and if not, I know that we're not.
Yeah, I'm not going to share specifically, but in general, what people see are 30 to 35% asset management. That's the value, and then investor relations is also usually 30 to 35% of the whole pie, right? The deal sourcing might be 10%. The earnest money, I think the key principle at the very end is probably 5 to 10%, and then the rest is probably the earnest money. So kind of do the math there. Asset management, we're definitely not the lead asset manager on that. That is definitely venture. Investor, that 30 to 35% for the investor relations gets divvied up based on how many investors you're talking to, what you're writing, and also how much you're bringing to the table. So
can I pause you there?
Yeah.
I like where we're going. I like this. So just to maybe paint the picture a little bit more. Imagine that for this one specific deal, there's 100 shares, just to make it easy.
Yeah.
Right? So there's 100 different little pies or pieces of the pie that you can have. And on top of that, just to make numbers simpler, say for this specific hypothetical deal, 70% of it will go to the silent partners, the limited partners, and 30% of the deal go to the GPs. And so the percentages that Ian's talking about now is the share of that 30%. Not of everything. So if the deal is $10 million, now we're looking at the share of $3 million-ish of the initial buy-in equity. Obviously, hopefully you double it when you're all said and done or something like that. But breaking down typical percentage breakdowns of a GP.
Yeah, I'm talking about the roles and responsibilities of a GP and then how the GP carry gets split. So carried interest or promote are the terms of that that piece that the GP gets for their work. So to share more about the waterfall and kind of the structure, this stuff can get super complicated when you start adding pref equity and all this stuff. But I'll keep it simple. A lot of times you'll see LPs get a preferred return, which may be 7 or 8%. And that accrues. So it doesn't mean year one you're getting your 8% return, but they usually get the first 8% per year goes to the LPs. And then after that, there is oftentimes a 70-30 split to the GP. Something that Matt Faircloth brought up and something that we have individually identified and many of us have noticed are that some operators, they basically just overraise and then they hand you back the capital that you raised to hit that pref, and then it goes to that 70-30, which is not a great thing. So Matt Faircloth at Best Ever Conference was arguing that prefs are going to fall out of favor, even though he currently has deals that have it. But he argued that it may be a trend to see less prefs. I've seen even the most blatant is to read the term on an OM that said distribution reserve. I'm like, okay, so this is a reserve to distribute if the property doesn't do well enough, right? Like, it's one thing to go higher on CapEx because you kind of need to be conservative on that, but to be so blatant about it was kind of shocking. What Venture did and what Tony has done as well is just a straight split. So Venture did an 85-15 split. Just pretty simple, no pref, no 70-30 on the back end, 85-15 on that deal. And I'd say on both the deal with Slocum, with the Best Ever, like my joint venture deal, and the deal, the larger deal, the syndication, it's common that a sale or refinance, 100% of proceeds, the initial capital gets returned to the investor, and then the carry part, it comes in afterwards at a certain split, whether it be 85-15 or 80-20. Those are the terms that I like. Some people like to add prefs and different equity structures and different classes where, here's another thing if you want to get really complicated, right? And you see these different tiers if you invest in the class A or class B or different tiers, and you see it's because different people have different thresholds and they want to say, hey, I want to get at least, X IRR, but what happens is they're lower down they're the first in line with at-risk capital. So it's always a risk-reward structure, right? And some people really want to chase that higher amount. So that stuff will get a lot more complicated, and they do it so that they can market and advertise to different investors that have different criteria, right? The deal that Venture was able to raise for, it's not aggressively, it's definitely not the highest return out of any deal you'll ever see. It's not super high. I'm not, but it's not bad. But at the same time, they've outperformed 28 out of 28 of their deals, whatever they've marketed. So people just know the facts, right? They don't have to market, this is going to be 40% IRR just to raise capital, right?
Yeah, there's so many different ways. I don't know. It's like now, I mean, technically I've only been part of one deal like this. And as you look at more, now that have done that side, you start to look at the different operating or the offering memorandums and the OMs and the pitch decks from a lens of a GP and not as an LP, just to see how they structure everything.
Yeah.
And there are different ways that you can pay yourself, pay the investors, and hide things. If you're on the spreadsheet, one quick number change can just jump you how much, like millions of dollars. You're like, oh man, this looks really good.
Yep.
So it's tough, and there's definitely an education and a language for it. Again, thinking about someone who's looking to co-GP on their first deal, if you had to say, okay, if you want to co-GP and they want to, wear your shoes now, Ian, and next year, what do you think is the next thing that they should do?
That's a great question. I think the education on their own, it's not just being a co-GP to check it off their list. There are a lot of great groups. We were mentored by the same person. Some of the mentorship, I'm sure all the mentorship groups are different, but you need to learn this stuff and understand it very, very well, right? You need to know how to underwrite. And then as you go through the underwriting, I thought, so one of the activities at Best Ever Conference, I don't know if you did this, was the partner hunting, right? And you can either be the brain, you could be the hammer, you could be all this, the money, the capital. And I always thought I was the brain, and I thought that I was the underwriter. But in being the underwriter and always sharing with people how I looked at deals, like it kind of attracted capital at the same time. So, money it's a weird thing as you try to scale in real estate. It's a chicken or egg thing where it's like you need the deal to get the money, but you need the money to get the deal, right? And it's like, how can you get the experience and blah, 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 right? It just kind of like goes, it's like, what can you get first, right? So for us, we wanted to transparently show like what our criteria was and why we said no. You want to get to know first, right? Like why we said no to either co-GPing on deals or like why we were unable to get to certain numbers, which built the trust to be able to raise the capital, and the knowledge that we learned along the way gave us the perspective to be able to add value to venture. You just did the social media editing for me, and venture talked about why they took us on as a co-GP, and I'm kind of flattered when I watch that because, in my own little imposter syndrome way, I'm like, what do I have to offer you? But they were like, you guys are great. Like you guys have helped us so much, and we always think like you guys are helping us, but obviously just by asking a lot of questions, going through all the underwriting, being part of a group that with Tony Lynn, where we learned so much, and then being a little bit of a thought leader to share with other people who would eventually later invest. That's what ultimately got us to the table to be a co-GP with this group.
Okay. For Tony's group, we didn't have to pay for Linfinity. There are paid mentorships. Have you ever done a paid mentorship before?
No, I haven't.
Okay, me either.
Yeah.
Which is an option, and a lot of times, and I'm not gonna knock it, right? Like there are ways to get into deal rooms that do have an entry fee.
Yeah.
And if you have money for an entry fee, or you're willing to give money for an entry fee, then cool. I don't think that's not the only way. Obviously, we went if you just show up and bug them long enough, then hopefully you can get a seat at the table. I guess is the approach we took. What about in terms of, I'm sure these two partners, Slocum and Venture, were not the only ones who you potentially thought about co-GPing. What are some of the criteria as you were looking at other potential partners and ones that you've said no to in the past? What are some of the things that you decided to hone in on that potential partner criteria?
Yeah, I think you build relationships over time, and it's like, that with different partnerships, you're just going to have different responsibilities and different experience levels. There is somebody that I'd consider partnering with. There are a few people that are younger and hungry, very hungry, but that would involve my mentorship as opposed to being the younger and hungrier one. So I've been on both sides of that table. So that's something that I'm looking at now, but then it becomes like whatever I do, I'm putting my stamp of approval on what that group is doing. And some of the younger folks they're completely savages with these creative financing and some of their negotiation is like, oh my God, like, yeah. So they're finding some stuff and there's some opportunities, but I know while they have some strategies and tools in their toolkit that honestly I don't even have, operationally they're sometimes a bit naive to what to go through. You have to go through it to go through it. So I know when I have to be more involved, right? So I think that's one thing. I think I'm also in a point where having too many partnerships does get to be, it takes up a lot of time, right? You've probably been through that, but it's like, because I have weekly syncs, I have a lot of weekly syncs now because there are a lot of different groups. And then there are groups that are just different, like Sarah Dynasty is like boom, 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 weekly sync with all these different groups of people. So that can get tough. So you want to be selective. You want to know what your core competency is and how you can help people, but you don't want to be taking on too many partnerships, right?
Yeah, I agree. Yeah, for me, I try and think about every group is a different acquisition strategy. Creative finance, it's a different market, right? Do I actually want to be in that city, in that area? I'm not sure. And it's tough because as you show up to more events, more people will give you these opportunities to say, cool, let's co-GP on this. But it's in XYZ city. Ah, man, that's another new market. You're good because you stick to Cincinnati. I have not been that great at it. And it hurts. And so I'm definitely being a lot more selective in terms of areas now. And then also asset classes, obviously, too, is a new development of play that I really want to play. Is entitlement really a play that I want to play? And yes, like things will get thrown at you, and it is super easy to just lean into the open door. But I've started to just hone now and just think, okay, no. And I mean, sometimes you got to, like, you pitch yourself like, did I really? What if I did say yes, though, right? Yeah. And so initially I said yes to a lot of things. Now I'm saying no to more things than I'm saying yes to. But I think, I mean, I'm going to assume for you, you kind of said yes to a lot of things with the first, handful of deals. You're just like, and numbers work, let's run it, let's go, let's pitch it. And now I guess for me, I think you have to earn the right to be a little bit picky. Mm-hmm. And then you also know what you don't like. What do you think?
Yeah, I agree. I think we're both the same, where we're saying yes to everything. We're doing everything. At least for me, my obsession with Cincinnati narrowed down some part of it, but I did do stuff, for example, with Fractional, which is a great platform. But then you end up in a lot of different ownership groups and things. I'm actually in a situation, and it's good. It's just an experience, and things are ending in the right way. But you have all these partners, and there's one partner that just has to be bought out. And I said, okay, because I think it shows confidence in the deal to buy the person out. I know even in syndications, the GP should be buying out the people that need liquidity, right, for their own, if they're opening up a business. And I was self-conscious. I'm like, oh my God, is anything wrong? And she was like, no, I learned a lot, but it's time for the next thing, right? So it just ends up becoming, it's an interesting experience, right? to do a buyout. But it also reminded me, like, you can't, because people's lives, they change, and you need to be aligned with all of your partners, right? So,
well, I'm gonna ask now, like, say this is from a fractional deal.
Yeah.
which is an awesome platform for you to crowdsource, bring friends together, learn about deals, and talk about money and active things together. On that sense, how does a buyout work? Like rough numbers,
Yeah. So Fractional, they put together an operating agreement that's very comprehensive to map out these situations, right? On this particular deal, think about what we can say. We are floating it off market, and we originally had somebody that wanted to buy it. But the partnership is not in agreement on selling both of them. They only want to sell one. So that was part of it. You need to vote to make these decisions, right?
because this is a JV, not a syndication.
Yeah,
by
it's
the
a
way.
JV, right? So we talked to everybody within the partnership. Very well laid out, very, very well. So we're all, we know the drill to be able to sell. There was one property that we rehabbed a lot, and that one did not get the approval to sell. They said, hey, just sell the other one, but we want to keep this one for cash flow, right? So one partner said, would you be willing to buy out my shares? And there is a formal process, probably with an appraisal and, or worst case scenario, Fractional buys it at X discount. But given that this is somewhat newer, and we have an idea that it can go for X amount, but considering that it didn't, we're just gonna buy her out at cost. Keep it simple. It's not like the investor had had their money in the deal forever, right? And it's the investor is happy with the outcome. So pretty simple. Just buy at cost and take over that ownership.
Okay. Switching back to the syndication world, maybe we'll end on this. What's a lesson learned for you for co-GPing, syndication? What will you do differently, I guess, for the next coming deals?
I think differently. I mean, there are a few things, because every step of the way you're reflecting on like, what can we do better? I think, we don't even have like a newsletter, honestly. I manually do a lot of things. And I think that manual touch is good. Like the individual calls with investors are really good. The individual emails to specific groups with personalized headers are good. But you can be a little bit disorganized, right? So there are some operational things to be more organized. Would be interested to hear what you think about that. Very simple tip on our presentation. They say, I don't know if you have, like when you do a deal launch, most operators will kind of hint at a deal, even if they know it's coming for a little bit, then they find the right time to launch the deal. I hear from a lot of people that the ideal time for a presentation is 40 minutes. I structured my deal like the way I do. It was very comprehensive, and it got to the point where I didn't want to talk the way I talk with filler words and stuff. So I actually like mapped out exactly the script that I was going to say. And I wanted to highlight, every real estate deal has a horse, a jockey, and a track, right? The horse is the property, the jockey is the operator, the lead sponsor, and the track is the market and the market conditions that you're operating in. So I wanted to tackle all of those, and I kept the market part short because I talk about Cincinnati so much. That way I could focus on the other two. But our presentation was like an hour and 4 minutes when I know people had a hard stop at an hour. And I didn't even get to the slide that has the QR code with what to do next, right?
Oh,
so
no.
a lot of people, it was an incredible turnout. There were 90 people on the call, but the response, the action, the call to action right after was not there, right? Like nobody responded because it was late by a few minutes. So if I would even put the QR code on every single slide. I don't know what you think about that. But
Oh, 100%.
Like literally, as I'm talking and people are like, oh, I need more information or I need to send an email, boom. Like they see it every single slide to take action. And I had other real estate calls right after that presentation, just because not a smart idea. You have to do your follow-up right after. So I didn't send my follow-up until a day after. So it almost looked like it was like successful because so many people were on the call, but then it seemed like it was unsuccessful. But then it's like you want to strike while the iron's hot. And I did my follow-up email the next day, and then everything started flooding in. But I would definitely do that differently. And you're the marketing pro, so would love to hear your thoughts on that.
No, I mean, I love the idea of putting a QR code to whether it be book a call, submit the form, do the initial soft commit, whatever it is, on every single slide. For me, what I also think about is you're much more smarter than me on the numbers sense, and I know you're way more detail oriented than me on that side. For me, on a sales pitch and my sales background, I feel like we have very different selling mentalities, which actually I think we would eventually make great partners together, is because we would sell differently. I'm very much so like, could I sell it in 20 minutes or less? Wow. And what would it take to make it that succinct and that convincing? Which is very, very, very hard to do. And then to add to your follow-ups, I think 40 minutes is a really good time to get enough detail and leave some time for Q&A at the end. And then the follow-ups for me is, what is the one-pager or the 1-minute pitch that makes it easy to confirm, like, what are the essential details? Mm-hmm. And I think a lot of times, a lot of groups from what I see don't actually have like that one-page wrap of like, you do this, here are the top 5 ways why it's amazing. Yep. Plus call to action.
Yep.
You need that because it has to be simple.
Yeah. I definitely overwhelm people. I'm very aware. My email had the 1-pager, which is good. But afterwards, that was another reflection that on an early slide, it's like, here's what you get, rather than like detail on like operator, property, all this stuff. Yeah. Like, it's like, here's what's in it for you. Like start out very simple, right? And then it just ends up long because after the hour, there was 20 minutes of Q&A, and it should have been probably earlier. So it's like, yeah. And it's like, I do this so much that I should know better, but yeah.
I mean, you're excited, you're passionate, and it's tough when you're running a public webinar. But I mean, we could probably talk about this all day.
Yeah.
Congrats on
Thank you.
The next big deal. And I'm excited to see, what the next couple years has in store for both of us.
Very excited for the next thing that you're up to.
Ian, how can people find you?
You can find me on Instagram at Cincy Cashflow, and also on LinkedIn, just search my name, Ian Cruz, CPA. Yeah.
Sweet. And obviously this was a deep dive into commercial real estate, into bigger investments. And so if you have any questions, make sure to leave them in the comments below. I'll try and get to them. Maybe Ian will try and get to them. If you enjoyed this episode, please like and subscribe wherever you are listening to this on. And if you want to see Ian's first episodes that we did and how to evaluate commercial real estate and what value adding an ADU builds, I will leave that video linked down below, or you can click here. But Ian, man, thanks so much for joining.
Thank you.
My cheers.
Cheers.